Hello, everybody, and welcome to the ISTAT Learning Lab again. Today, we're going to speak about jet engine leasing under COVID. And to do that, we have Graham Cricket in Amsterdam. He's the Chief Technical Officer of SMBC Aero Engine Lease. And he's been there since 2014. Otherwise, Graham has over 43 years of experience in our industry. And that includes 15 years with Air New Zealand Engine Shop and 10 years with the Royal New Zealand Air Force. Before starting with SMBC, Graham acquired leasing experience already in 1998 with Air New Zealand, and he's also enhanced this with senior positions at Willis Lease and Macquarie, IBA, GCAS, and general consulting to the industry. Graham has an aircraft engineer's license, and he's has a graduate diploma in engineering management from the University of Auckland. Graham has provided detailed support to numerous ISTAT appraisers in the pursuit of accurate, reliable, and consistent information to this industry. During Graham's presentation, you can write in questions by clicking a little Q&A button at the bottom of your screen. And then we will monitor those. And I am assisted today by Jen Zhu from Altson Aviation to pose these questions to Graham and discuss them with him. And Jen is based in Hong Kong, and she has over a decade of experience in advisory, in aircraft leasing and financing, expertise in investment analysis, asset valuation, cash flow projections, and financial modeling. She is accredited as a certified appraiser by ISTAT, and has a CFA charter. And before Alton, she was with Skyworks, and she's also been with ICF and in various advisory positions. Jen has a BS in Business Administration and a BA in Mathematics from University of Richmond, and she has a Master's in Operations Research from Columbia University. And with that, I want to hand over the microphone to Graham Cricket. Over to you.
Thanks, Nils. Welcome, everybody. Thanks for dialing in. It's an hour-long presentation with roughly 30 minutes allocated on the top of that for questions. So please take notes and feel free to bounce some questions in. At this stage, I'll just start the video. So share the screen. So we can see that.
Yep.
Okay. So essentially, I was requested or asked if I could do something early on this year, but due to work commitments and the condition of the market, it was really tough. So I've managed to find some time and put something together, and hopefully give you an impression of what the current market is in regards to engine leasing. It's quite a specialized role, but to do that, I also need to back up a little bit as to pre-COVID and also some of the specializations that we have in the industry that you may or may not be aware of. So while I think a number of you that are dialers, people that have dialed in, have an appreciation of aviation, you may not have a specific knowledge of engine leasing as such. So if you do, please forgive me in covering some fairly basic stuff, but essentially we all, by the end of this presentation, hopefully we're all on the same page and the same understanding. So I just need to make sure that there's a rider here that everything that I talk about and raise today is solely my point of view or perspective, and it may or may not be my parent company's SMBC Aero Engine Lease, or SAIL as we call it. It may not be their opinion, so that's there. So introducing SAIL, or SMBC Aero Engine Lease. We started as a slightly different name, although it was sale. It was Sumisho Air Engine Lease. We were started in October 2014, based here in Amsterdam in the Netherlands as a joint venture between Sumitomo Corporation from Japan with 90% ownership, and MTU, the engine manufacturer, and MRO based in Germany, and they hold a 10% ownership structure. Equally at the same time, MTU launched their own MTU lease services, also based here in Amsterdam. We shared an office to start with, in which case Sumitomo Corporation has 20% of MLS and MTU has 80%. Our sole remit at the time was to concentrate on long-term leases of jet engines, and the tear down and part out, the MRO side, and the short-term leasing, in other words, less than 12 months, that was to be looked after by MTU Engine Leasing Services, so MLS as we call them. We've since October 2014, we've grown around 75 engines. We've done a lot of trading. So a lot more of engines have passed through the books, and currently we're sort of around $720 million worth of capitalization. We're quite proud of that. There are a lot of engine leasing companies have maybe not done quite so well, and I was involved with some startups earlier in my career, and they no longer exist. Through no fault of my own, of course. We have a mix of wide body and narrow body. We've got GenX engines and GE90s, and then the remainder, there are a small handful of narrow body, small handful of regional jets, CF3410Es on the Embraer 190, 195s, and the rest are buddy spread out of the narrow body Neos and COs. So that's the new engine configuration or the old engine or the current engine, so the V2500s, 5Bs and 7B markets. We have LEAP 1As, LEAP 1Bs, and geared turbofans, of course. That will be our growth strategy going on forward from here, but that's not to say that we won't do any trading of the other types when and if they pop up and prove to be a profitable concern. So we were trading and profitable from day one, which was really unusual to the other startups that I've been involved with, which were traditionally loss-making facilities until they reached critical mass. Our remit was to provide a profitable dividend every year, which was really quite stressful at the time, because in trying to grow, we were trying to sell at the same time. So that didn't make me feel very comfortable, but that was the remit, so that's what we did, and I'm quite proud of that now, but at the time it was quite stressful, as you could imagine. So in 2019, Sumitomo Corporation decided to sell our holding, their holding to SMFL, which they had a joint venture with. So that's the finance leasing arm of Sumitomo Corporation and SMBC Bank, also of Japan. So we have grown since that, more capital raised and available to us, and we've been given directions to advance for significant growth in the future. I'm proud to say that we've grown nearly 100% since 2019, and that's very comfortable and quite a challenging operation, as you can imagine. So if I could just go back a little bit and go through the engine leasing in general. A lot of people think that just because there's some engines that are attached to airplanes and there's aircraft leasing, that they're a similar sort of entities. They are in some ways, but distinctly different entities in others. Jet engines have got their own classification as an investment, as well as the aircraft themselves obviously are very much an investment center. So so when it comes to particular jet engines, they're more detail sensitive. They're a sophisticated asset, so the management side of the asset is very important. You can't hide value influences, i.e. losses, readily. There's nowhere to bury them. Unlike perhaps if you bought a $55 million airplane and you're losing $1 million per engine because you have agreed a certain set of circumstances that the engine will come back in a different configuration or value, and you have an impairment to take on those engines. You can sort of somewhat hide that or bury that within the airframe. if you're losing $1 million on an engine, there is nowhere to hide it. It is there plain and stark and very open if people know what they're looking for. The engines are very portable. Aircraft are not quite so portable. They usually have tail numbers and they need to be put on a register to move from one country to another. Where engines, just you put them on an engine stand and provided you export them correctly, of course, you can move them around fairly quickly. The engines, while they're still in current production, are subject to the OEM production escalations, which can and probably does form a good way of trying to recognize the escalation of values over time. Once the engine is out of production, then the rules change a little bit. So essentially, if you're in production and the engine runs for 15 to 18 years, you can count on some kind of upwards movement on values. Generally, the competition has a smaller profile. There are less aircraft engine specialists in the leasing market in comparison to there's a heck of a lot more aircraft lessors. For a number of different reasons, the prime one is that it's a very specialized and sophisticated asset. Even though the same asset is on a wing on somebody else's aeroplane, it's not normally treated in the same asset management fashion by most of the aircraft lessors or the aircraft lessor financiers. There is multiple installation platforms that are available that are just a thrust variable, your 5B6s, 5B5s, 5B4s, 5B3s, 5B2s. So all of that goes on the A319, 320 and 321 and similar other, narrow body platforms for different engine types. Basically, if you've got a legal thrust upgrade, you've got multiple platform options. So there's quite a bit more flexibility to the market. But usually engines have a longer life projection than aircraft on average. Over time, the aircraft will be retired and broken down for parts or tear down or put in a museum or wherever it likes to go. The engines usually get recycled and stay in the market for quite a bit longer. And historically, you can get over 30 years for some engines. I'm not sure if that's probably something in vogue in the foreseeable future. Certainly technology is making huge headroads into the lifespans of engines and aircraft, and obviously part of that is global climate issues, but equally as such there's more political influence as well. The aviation industry is heavily influenced by political and outside influences, so not just technology and things like that, but where you can fly and why you can fly and how long you can fly. The values of engines can be reset from engine shop visit refurbishment. So the value center looks like a sawtooth that burns life off, goes for a $3 million shop visit, gets reset. The value goes back up, depending on what kind of quality and what kind of parts that you put back into the engine. Aircraft doesn't tend to do that. They just tend to have a decaying value based over time. As the engines can also be subject to mechanical upgrades from the manufacturer. There's a product improvement package or something like that can add quite a large dimension of value and future proofing to a certain extent. And they're also subject to technical asset management sensitivities, like what do you want to track and why do you want to track it? And I can sort of offset that a little bit by the recent example where we tried to put a brand new 5B engine into a Russian airline, and they had issues about software interfacing. They've got older platforms, mid-2000s, and ours was a brand new engine, only 5 or 6 months old. Despite sending them all of the product support information from Airbus and CFM and all of the presentations that we had, they still elected to go for an older engine because they had problems with interfacing, and it was just purely their opinion, of course, and of course they're entitled to that opinion, but it scratched my head as to why they wouldn't want to take a new engine. They'd prefer a 15-year-old engine. I don't believe it was a pricing issue, but anyway, that's something else. So you need to track from an asset management perspective. There's two ways of asset management. One is a financial one, that you're making sure that you're invoicing and getting paid. And the other one is the technical asset management, as you know what is inside your engine and what it can and can't do. So engines as assets as a comparison to aircraft leasing. Engine leasing opportunities seem to have a much more truncated timeline for response. In regards, you might get a week. If you're lucky, you get 3 or 4 weeks advance notice of a potential lease or a sale and leaseback, and you need to move swiftly and accurately. Where on an aircraft, for example, you can start 6 to 12 months out on placements. So that means from an engine perspective, you need to move fast and you need to be aware of what the market is doing and whether or not you're at the front of it or at the back of it. Engine leasing is all about knowledge of the asset and how various issues impact the functional and operational ability of the engine on a day-to-day basis. They're impacted by ADs and service bulletins and software packages, and whether or not that's compatible with whatever fleet that you're trying to place that engine into, or even just trying to extend leases. So you need to know what your asset is. So part of that knowledge is you need specific technical details at a granular level, such as what kind of turbine blades are in there. Do you have a life for the fan blades? Because everybody wants to know those. What is the modification status? So again, it just means that you need to be active in your asset management. You can't be passive. You need to have that ability to know that stuff in advance, not in arrears. As such, the technical team is highly specialized, and you'll find the vast majority of sales and marketing people probably have some kind of technical background that aids in the asset understanding and discussions with potential lessees or airlines, or even if you're trading into the next level of where you're going to sell the engine into the next potential owner or purchaser, or even a financier. The engines are less tolerant of asset value movements and losses. So, and this goes back to what I said previously, you can't hide. If you're going to lose money, you can't hide it. It's there. And if someone knows what they're looking for, they'll find it. Or maybe there'll be a bit of a caveat emptor, which is, buyer beware. But certainly, it's very sensitive. But usually the engines are more stable assets over time. If the deals are set correctly. The quality of the lease is paramount in that regard. This is just a small shot. The blue line is a depreciation of the aircraft as an asset. And even though that aircraft has 2 engines on it, or possibly 4, over time the engine value will increase because of the production, current production, usually escalating at around 2 or 3% per annum. And over time, the value of the aeroplane will be dictated to by the value and the quality of the engines that are attached to it. The aircraft will go to the great crusher, and Budweiser will buy some cheap aluminium, and the engines will live to fly again, usually. So now we come to COVID. So, COVID is 2020 onwards. Initially, we all thought or hoped or believed or had our fingers crossed that COVID would be a 3-month issue. Then it turned into a 6-month issue, then a 9-month, then 12-month, and now we're talking 2 years, 3 years, and 4 years for different market segments. So what has actually COVID done? So we had a lot of people talking about the market last year, 2020, but as what we can see, there are no fire sales, no massive airline bankruptcy. Yes, there are airlines in trading insolvent, if you want it to be a technical term. We've had massive subsidies or financial support by various, either they be owners or financiers or governments to certain parts of the aviation industry, some airlines, some not. But essentially, there are some airlines in Chapter 11, but nowhere near what we used to see in maybe the global financial meltdown in 2007, 8, 9, 10, 11, 12, where we had bankruptcy pretty much 1 airline a week. We haven't seen that. We haven't seen anybody dropping, 50 airplanes on the market looking for a fire sale. There's no evidence of massive fleet early returns. Yes, they may happen in the future, but they haven't happened yet. So there have been some, obviously, returns, but on average, if you looked across the world, most of the capacity is parked up in the desert or in some kind of storage facility under storage maintenance programs. But, there's no airline that said, come and pick up your 100 aeroplanes. Obviously, Aeromexico have handed back a number of their 737s to various people, but that's under Chapter 11, so that's tolerated. And some of those have found homes and some of them haven't. There's no evidence of leasing companies going broke, which I thought was possibly a contender last year, where, airlines pretty much stopped paying rent for whatever asset they had on lease, whether it be an engine or aircraft. It didn't sort of make any difference. And then everybody hoped it was a short term, and now it's sort of turning into a medium term, and one or two cases might turn into a long-term situation. There is evidence of a lot of airlines in distress. We are probably no different from any other engine leasing company. I can't speak for aircraft leasing company, but it's probably very similar. So initially we had creditor issues with about 70% of our customers, and that's a lot. Obviously that's been it changed over time. We've got a lot less than now, but we still have a fairly significant number of people who can pay but won't pay, can't pay but do pay, and then just plain can't pay. And then, we're trying to support them in any way that we can. It certainly has highlighted which airlines that we'll do business with in the future and which airlines we won't. Or in other words, we won't put a lot of effort into whatever bids that may pop up. There's obviously evidence of a lot of parked up capacity, delaying shop visits, delaying repairs of parts, back robbing of parts off engines and airframes, trying to keep some aircraft flying, and while the rest of the airline is parked up or in some kind of program for maintenance or storage. That is a delaying mechanism, and that happens in every downturn, whether it be the financial meltdown 10, 12 years ago or any other September 11 event. And, usually there's a crisis in aviation every 7 to 10 years. So whether or not we were due another one, it's immaterial. This one's we're facing. It's a big one. It's deadly serious. Some people call it a black swan event. I'm not sure that the swans would tend to like that, but essentially, if a black swan is a bad event, then you certainly we're right into that. Is evidence that the virus is significantly deadly and long-lived. So it's not going away. No matter how many vaccinations you have, it's not going away. There has to be a way of finding a long-term solution to the situation, and whether or not that's a tolerance factor or, at some stage, there's a better vaccination program, but essentially everything is run around the vaccination program. And now we've got regional or localized issues about that program. I think it's quite easy to say there's evidence that global and governmental responses have been exceptionally poor. I think, for somebody who's fairly cynical in my line of work, I think it's just proved that the local government politicians are as useless as they were always thought to be. Maybe not in their own minds, but certainly what we've seen is exceptionally disappointing. They can't coordinate their own countries, let alone coordinate anything between countries. And even the EU was all over the place within separate countries as well. So I wouldn't hold the EU up in the shining light and say they've got it right. I think they've done their level best to do things in the manner, but they're usually been retrospective and not in advance. They haven't got control of anything. They've been working in arrears, which is really incredibly frustrating and difficult looking from the outside, because these guys tout themselves as experts and quite clearly they're not. So other things about COVID sensitivities, and there's a slide a bit later on. So, the price of oil is the same pre-COVID. The price of finance is very similar. So a lot of the market pre-COVID is now, the sensitivities are now the same today, mid-2021. The cost of finance is a little less, but it's susceptible to the Fed US dollar movements, and that is going to be a bit of an issue later on this year. If inflation starts to run away in the USA and they start to move the US dollar, then as most airlines and commodities are based in US dollars, everyone's going to feel that pinch. So the timing of low interest rates, there may be some writing on the wall, but we've been saying that for the last 4 or 5 years and nothing's been happening. What has changed significantly is the risk burden to the aviation asset owners. So what we've seen is the airlines are passing a lot more risk on to the aircraft owners if they're leasing, or the engine owners if they're leasing. So, and they do that by a variety of manners that we'll cover shortly. So here is a little bit of research. So 2019, the price of crude oil on average was about mid-2019, was about $64.30 a barrel. It dipped down to $41.96. 2020, when the demand dropped off and no one was flying, and therefore the demand for, the price of oil dipped to try and stimulate demand, but that wasn't the problem. The problem was that nobody wanted to fly, and if they could, they weren't allowed to fly anyway. 2021, we're now looking at $63.16 on average. Now, we do see movements in there, so this is just a snapshot in time. I don't profess to be an investor in crude oil. This is just what I found on the net when I was trolling around. So the US Treasury 10-year swap rates, yeah, not a lot of difference. 1.65 in August 2019. That was, unfortunately, that month with a huge dip. Biggest fall since 2008. Prior to that, it was holding a little steady, but obviously, the world woke up in a real rush that this COVID thing was a little bit more serious than what everyone was believing it might have been, and the US Treasury 10-year swap rates got a little bit of the jitters. It plunged heavily in August 2020. Obviously, 2020 was a few issues going on there, obviously with COVID. In August 2021, we're sort of starting to move back up a little bit more, starting to price in risk in the aviation industry if you wanted to borrow for, long-term 10 years swap rates. In 2020, it was very difficult to get 10 and 12-year swap rates, and anything over 12-year swap rates, no one would quote. There was a lot of quotes on 7-year money and 8-year money that was slightly different as well. And the other thing is that pre-COVID 2019, at least 35% of all airlines globally were loss-making. So there was a bunch of airlines that were profitable in the world, but not that many. And so you had the occasional airline doing exceptionally well. Most were reasonable. Most were borderline. And then there was a fairly decent chunk that were high risk, non-profitable, and their market share or segment was being gobbled up by other low-cost carriers. So, pre-COVID, the world wasn't rosy. It wasn't too dissimilar to what it is now. However, when you look at the risk associated with the profiles of aviation investment now, they're significantly higher. So the aviation market, COVID today and tomorrow. So the recovery. So there's evidence that recoveries are sporadic and localized to regions. So I didn't say regionalized because that sort of means a regional aeroplane. So that's the terminology that we use in this industry. So they're localized. When I say localized, it'd be North America would be one. You could maybe want to overlap Mexico into that, and then there's Latin South America. That's a different market. And then you're looking at the EU is a different market. Africa is a different market. The Middle East is a different market. Australia and New Zealand are different markets. And now we're seeing, a very stressed environment in Southeast Asia. And obviously, in the last 4 or 5 months, India hasn't been flash. That's not to say that the countries around them are any better, but that's just what seems to be hitting the news. So there will be mini recoveries, generally localized. The emerging evidence of country alignment on travel policies. We're finally starting to see some common sense and, moving between the UK and Europe and America and Europe and America and EU, although that's not necessarily reciprocal at the moment. Certainly all the Americans can travel to the EU, provided they've got double vaccinations and certs, but the EU can't move to America. That needs to change. It probably will over time. America's not never known for moving fast. So there's convincing evidence that a vaccination program will be the only way to resume as close to normal travel as can be expected. And that's, it wasn't. So if you go back to the 60s, 1960s, 70s, which may be a long time for some of you, for me, it was part of my childhood growing up. If you wanted to travel, you needed a vaccination certificate. I probably still have mine. When I was in the military, for example, you needed a vaccination certificate. If you're traveling, there was a lot of cholera and stuff like that around, and a lot of malaria, and you needed a certificate to go to those places. So, the latest discussions about vaccination certificates, it's nothing new. It's just, reinventing history again. So nothing to be concerned about. That just gives you, it's another passport for travel. If you don't have it, well, that's fine. That's, if you don't want your vaccination, that's fine. That's your choice. However, there are impacts. And I think in our aviation industry, if you wanted to get back to travel in some manner or form, then, I think everyone will queue up and get their vaccination certificates pretty darn quick. Emerging evidence that in some regions, Southeast Asia, Africa, Asia subcontinent, are many months away from a planned and executed vaccination program, and therefore aviation stability. We're seeing, Indonesia, Philippines, Thailand, those kind of countries have got a real problem on their hands, and there's no short-term solution other than getting a lot of vaccinations and getting some kind of control back over the community in regards to their safety and well-being. So the chances of us, globally flying in and out of those countries is pretty remote, and those countries servicing their population into other countries. It's well known that the Philippines are great travelers of employment, and same as Indonesia. So those things are stopped. History will not cover many governments and their leaders in praise. Well, as I say, I'm fairly cynical. I think when the truth comes out and it'll be written up in history, I don't think there'll be many governments in many countries that have said they've done a great job consistently. A vaccination passport equivalent that is globally acceptable, and at the moment not all vaccination certificates are acceptable, will be required for most travel for the short term at least, or medium term foreseeable future. Travel to any areas that do not have vaccination programs will be significantly impacted. So therefore that affects our industry. Business class travel, I'm picking, will return, especially with respect to respected airlines with controls flying in and out of countries. And I think, the theory that you can do all your business by Zoom or by phone call, I think is wishful thinking. In our industry, it is better to have a physical face-to-face relationship at least once a year. Maybe you won't be doing it every 2 or 3 weeks or every 2 or 3 months, but essentially business class travel for our industry will return. It may be limited in some format, but it will return. COVID sensitive, right? So I have a few issues with what was being said last year. I'm quite opinionated in this. I think what some people have done is played COVID Olympics, but in my opinion, the market is not a game. Despite no actual evidence of any fire sales or mass aviation assets being flooded back into the market, bankruptcies, huge distress, the market was being talked down by a number of people. It may be over time that the doom and gloom forecasts comes true, but at the time that a lot of these people were talking the market down, it wasn't helpful, and it wasn't reflective of actual market conditions. We had people saying that airplanes were worth 50% less on Monday than they were on Friday. there was no substantial evidence of that, or there's no evidence at all when you looked at it, because, while airlines were in distress and packing airplanes and engines up, there was no fire sales. There was no 150 airplanes here, can't find a home, you come and pick them up for $1, there was none of that. So a lot of these people that had these opinions, and they were very keen to voice these opinions in the market, and a lot of people were soaking that up. They were largely not reflective of the market, and they weren't jet engine lessors, nor were they jet engine investors. They were not even recognized jet engine specialists. But because they knew what an aeroplane looked like, and they could probably draw a reasonable outline on a piece of paper with a blunt crayon, they thought their opinion was just what the market needed. So I'm pretty cynical about this, as you can rightly guess. I have no time for these kind of people. They do a disservice to the industry, and the aviation industry especially when it comes to talking down things that investors are super sensitive about in the first place. What was needed was a calm reassessment and a requirement to just hold fast and let this thing work itself out. There were very few engine leasing specialists who advised, there was some great talk from Engine Lease Finance CEO. There was a little bit from GCAS, and obviously some from us, who advised the need to actually know what people were talking about. They need to be a specialist, not a generalist. And usually aircraft leasing, when it comes to engines, are more generalists than specialists. At the same time as the talking heads were voicing their opinions, a few of the engine leasing companies were talking up the market. So there was obviously a conflict of opinion there. Whether or not those companies were looking for finance or supported finance, and good on them for that. But obviously, if one side of the market is talking the market down and the other side is talking the market up, then both can't be right. So it just adds to the conflict and confusion in the market. And I don't think the doom and gloom advisors or talking heads added a lot of value at all. I think they undermined the confidence in the market, made it worse, especially when the thought that it went from a 3-month problem to a 6-month problem to a 9-month to a 12-month problem, and now we're looking at 2 or 3 years. The overall consensus is that maybe they talked the market down just a little bit too fast. It may be that the market has real problems in the short to medium term, but without evidence to back up the opinions, that they just were opinions, and that's all. And they were low quality opinions, and did themselves and the market a disservice. So where do I see the recovery coming from? Well, a lot of it's common sense. You don't need to be a genius to work some of this kind of stuff out. The wide body market will struggle. It will struggle until they can fill those 300 seaters, 400 seaters with a consistent number of passengers willing to pay the fees, because prices, airfares internationally have unfortunately increased. There's a premium on that now. And until things like the A380 can fly with 95% loading on some of the longer legs, it's not going to be too efficient for the airlines to operate. So the 777 series, there's a lot of airlines that have either cut their fleets or talked about cutting their fleets, or cut their fleets out completely. And of course that flows into the A330 series and the A350 series. Some of these aircraft types will not recover in full. If they do, it will take some years. If you're flying between the United States and the UK or EU, if you've got 150 passengers, then why do you need a 350 seat aeroplane? It doesn't make any sense. So that kind of thing is going to take a while to recover. And also, when you have fleet dominance, when over 50% of the A380 market and the Boeing 777 market, when the biggest operator of that is Emirates, that has a huge influence on the longevity of those particular types. Now, don't get me wrong, because I think the wide bodies aeroplanes have been a fantastic addition to the world fleet. I am particularly keen on the A380, especially when it's flying long legs, and you can get that, you know, cost per flight hour, cost per seat kilometre down to a reasonable level and make a profit on it. What it doesn't do, unfortunately, if it's only half full and flying a 6-hour leg, it's a pointless operation. Narrow body is heading to a localized recovery, but capacity and demand can rapidly respond as required. In other words, airlines that are packed things up, packed airplanes up, put them in a program if they needed to move, just like at the, you know, when we came out of the crisis for September 11, and when we came out of the global financial issues, we had airplanes coming out of storage because the aircraft manufacturers, they can't ramp up. While Airbus is talking about getting to 70 airplanes a month, that's a pipe dream because they have supply issues, just like everybody else. There are engines getting packed up now because they can't get the circuit boards for the FADEC unit. So I wouldn't see airplanes any different from that. So you know, you just can't magically wave a wand and produce 70 airplanes a month. It takes a long time to ramp up to that. So if airlines want to recover, they just get the airplanes back out of storage and they start moving them in that manner. When you can fly an A321 between New York and the UK and the EU, why would you fly a A330 or a 777? Why would you do that? Especially if you're only carrying 150 packs. It doesn't make sense. The CEO engine models will not be mass culled, and everyone is talking about, you know, the price of oil and all that kind of stuff, and the efficiency of the new LEAP engines and the geared turbofan engines. Well, that's pretty much a misnomer, to be honest. It's all about cost per flight and cost per flight operation, and the engines are nowhere near reliable enough, in my opinion, that the engine models they replace are significantly more reliable. They're already on the wings, and the wings are already there on the airplanes, and the airplanes in storage. I can't see them having a mass exodus and replacing them with Neos. Exception to the above would be the 737 MAX, of course, where there's a number of airplanes already packed up, and it's not necessarily with the airlines, it's with the manufacturer, but that's a different issue. OEM aircraft manufacturers, while announcing, you know, increasing production rates, it'll be some time away before they can do that ramp up. It's just not essentially a viable thing in the next 1 or 2 years, that's for sure. So the engine leasing strata. Now we're getting into the nuts and bolts of why you guys dialed in, so apologies for the time lag. Wide body, pre-COVID. So there were sale and leaseback opportunities, most of them for long term, not so many G90s, but there was the Rolls-Royce XWB engine was very popular. GenX engine was very popular. The Trent 1000 was maybe not quite so popular for sale and leasebacks. So it was quite an active market. It was a competitive market, 10 to 12 year terms, nothing shorter than that. They were current production variants, so it wasn't sort of like you'd say a CF6-80C2, you know, a bunch of those coming into the market. There wasn't that. It was more like current production variants, the new technology stuff, the 787, 777, and there may have been the occasional A380 package, but that was a very specialized unit and hardly anyone went down that road. There was some short-term and medium-term shop visits, support leases, and in other words, short-term wide-body requirements to cover some kind of maintenance event. That was predominantly supported by GCAS for the GE engines and Rolls-Royce through their own engines. So we didn't get involved with that. We didn't have any wide-body engines parked on the ground, so it wasn't our market. There were reasonable returns for the wide-body in theory. provided that everything went sailing and COVID didn't pop up. But now it has. There's a different story in the financials. So, and the maintenance reserves were commonly paid at lease end. It was adjustment at the back end of the lease, and you were quite happy to take the risk of the lease running through and the airline surviving and all of those kind of things. The wide body current situation. Obviously, most of the wide bodies packed up. The deals out there at the moment are what you call power by the hour deals, and it's not the traditional sense of power by the hour. This is if it's not installed and parked on the ground, then you don't get paid. So the rent and the maintenance is paid once the engine is installed on wing, and those are very aggressive rates at the moment. Essentially, in my opinion, the wide body market is either dead or on life support. And there's no short-term horizon recovery for this thing at the moment, not that I can see. The rent is down for 30 to 40% on some airline restructures. On other airline restructures, it's down 60, 70%. So you're talking about going from $150,000 to $200,000 of rent for a GE90 down to $65,000 a month, and only if it's installed on wing. And there's a fistful of them out there as well. You know, the GE90 115B, it started with about 13.7% spares ratio, which was way over the top of what it should have been. Now you're probably talking about a spares ratio of about 28%. So that's going to be a problem child for a while until they get a handle on a few things. You can't tear down that kind of engine in the market and hopefully swallow all of those parts and push them back out. You know, shop visits are still averaging about $9 million for the first one and $16 million for the second one. And currently, the maintenance reserves being paid on these PBHs don't cover the first shop visit. So this is not even a remotely sustainable situation. So pre-COVID, these are the sort of baseline engine prices, new, give or take. There's a little bit, depending on thrust variance. So the GE90 is around $40 million. Not that anyone was paying that, but you know, for a while there, GE was giving about 10% discount to engine lessors and probably about 40% discount to aircraft airlines. So that's COVID impacted that engine type. The Gen X is COVID impacted. I don't believe, I haven't seen any brand new sale and leasebacks of Gen X engines for 2 years, so I can't see that happening anymore, not for a while anyway. The LEAP 1A, again, it floats between $16 and $18 million depending on the thrust. Essentially, on the new pricing in the market today, that hasn't had any COVID impact whatsoever. The LEAP 1A and the geared turbofan, exactly the same. So if you're doing sale and leaseback of an engine, you need to expect to pay full list price or CLP, was current list price. There may be some discounts available, but that's sporadic and don't plan on it, that's for sure. And the CF3410E, when I'm only talking about engines that I'm familiar with here. I can't talk about the 80C2s, although I'm familiar with them. I can't talk about the Pratt & Whitney 4000s. I can't talk about Rolls-Royce engines. We're not approved for that. We're not exposed to that kind of market. So please, you know, understand that I'm only talking about the engines that we currently have in our portfolio, but I think they're symptomatic of where the industry is overall. I don't think they're out of alignment. If you wanted to buy a brand new CF3410E, the price is about $10 million. They're an expensive little thing. And I'm sure GE would love to sell you one, but unfortunately, the market sustainability is down around the $4.5 to $5 million range. So $10 million brand new CF3410E is probably not a wise investment. It's currently end of production as well. You can also, so you know, the next slide will cover the COs, the current engine options, which is now the obsolete options really for the 7B, 5B and 2500. Now, on top of these, you've got, it's all very well having an engine, but you need a QEC kit for it because that's what the market requires or demands. So you can easily add $2 or $3 million to each one of those engines on top of the purchase price for the engine. And then you have to have it installed and certified and all the things that go with that. Largely, the sale and leaseback market of the Neo engines hasn't changed since 2019. Hasn't changed. There was a little bit of discount in 2020, but not a lot. There were very few sale and leaseback opportunities in 2020, and we were pretty much the only game in town. Most of the other engine lessors were a little gun shy and hanging back. So we did exceptionally well. We got well over 20 odd engines last year, and better deals than 2019. But certainly that finished in January 2021. That stopped with a snap. And immediately in 2021, what we're seeing now is the returns on engines on sale and leasebacks is worse than or less than what it was in 2019, and they were pretty tight then, I can assure you. So from largely there is no, I don't think it's a wise thing to rely on discounts from Neo engines if you're doing a sale and leaseback into the market. The discount is all being rolled up and absorbed by the airline, not by the people financing it in the end. So engines as assets. So what about the used engine market? So this is the one that everybody talked down. Okay, so these are just snapshots that's very sensitive to the condition and thrust and the modification level and operational life remaining and where it's been operated. Has been operated in India, China, or North America, or Europe. What are those kind of things? So this is a generalization. The demand for the 5B is very soft at the moment. There seems to be a lot of spares in the market. 2018, 2019, CFM pumped a lot of 5Bs in the market because there was a shop visit demand. And once that shop visit demand disappeared, then so did the desirability of all the spare engine 5Bs in the market. So there's quite a number of them out there at the moment. The 7B market is firming up. There's not many good ones. There's a number of, what I wouldn't call them poor, but I'd call them EGT margin sensitive. And some airlines in North America have tried to soak up quite a large quantity of them if they possibly can at cheap rates. So they've taken a lot of the good ones off the market. So the 7B is firming up. The V2500 is fluctuating at the moment. There's a recurring AD that just can't seem to be killed off on the HPT stage 1 and 2 hubs, or discs as you want to call them, and that's creating demand. That's for sort of shop visit sort of support programs. So there is a demand for good engines out there, predominantly more modern ones rather than the older variants, the non-select variants. The Gen X engines, the demand is not there at all. If we had a spare one on the ground, which we don't, there would be no demand. And the CF3410E, the short-term demand is increasing because they are shop visit sensitive now. So instead of doing the 5-year leasing, you're talking about anywhere between 6 and 12 months, maybe slightly more, a little bit more towards green time type leasing. It's a support of shop visit programs. And we go back to this power by the hour rates as well, which are there. Then there's some airlines in Europe that have locked up a 5-year lease on an engine on a rate of maybe 35,000 a month or less on a 7B, and only pay if you install the engine. If it's parked as an emergency spare, then nothing gets paid. Well, that's the kind of market we don't play in. There's no return on that. I'd rather have the engine sitting on the ground and waiting for a better lease. At the end of the day, some people need to get cash flows going and get engines on lease for a variety of reasons, and we're not one of those. So what about the used engine values? Okay, Now, this is where I sort of differ a lot from the ISTAT appraisers. I do consider the ISTAT appraisers, the vast majority of them, friends and colleagues. I've given support to them over the last 18 years. And that's, by the way, that's free support. I don't charge for any of my advice or support. I do that willingly because I believe they're a very valuable part of the community, and the industry needs those. And when I first started supporting them in the early 2000s, getting this information to them was exceptionally difficult. The OEMs were not letting out anything at all. You know, I'm grateful that the OEMs have woken up, you know, about 10 years ago and realized the important part of the aviation industry finance support network these guys do. So I'm quite proud to say that I support the ISTAT appraisers program. So where are we with the 5Bs? Used, serviceable. Again, all of these need a neutral Kiwi C. If it doesn't have a neutral Kiwi C, then you're in a different ball game. So the values are down about 15% on average. If you've got a high thrust engine, then it can add a little bit more. But generally speaking, if it's a low thrust engine, then the money comes off the table. So you'd be a bigger discount than 15%. The 7B, again, is down about 10%. It was probably 15% a little earlier this year. Now it's 10%. It's firming up a little bit more. The A5, the demand at the moment is for exchange. That's what we're seeing. We have some V2500s, and what people are looking for is an exchange. They don't want to put the engine through a shop visit. Shop visits can be really expensive. You're talking about $3.6 to $3.8 million for the shop visit, and then $4.3 million, $4.4 million for the LLP stack. It's pretty easy to get up towards $8 million. Pretty sure IAE will sell you a new one for $9. So why would you bother with the old one? But it's all to do with timing. So, you know, you can end up with your engine in the shop for over 6 months, in which case you're paying rent on the aeroplane as well. So there's other influencing factors for airlines to try and do exchange programs. So it's very hard to say what the overall market is for the A5. We believe it's sort of closer to the 10. If you've got a good one, it's closer to the 10. If you haven't maybe got quite so good one and the LLPs are non-aligned, then you could be in the 15%, maybe slightly more. It could get into 17, 18%, but that's a big discount. The GE90, there's just no market other than tear down or green times, and the value has plunged on that. So most GE90s will probably be around the $20 million on book values if you're lucky, as long as it's a few years old, maybe 5 years old. You may have collected a few bit of maintenance reserves, but if you've got a $25 million engine, you are not going to get $25 million for your engine, guaranteed. And I don't think that market will ever come back. That's my opinion. So with that engine variant, unfortunately, it needs a lot of work and a lot of support programs put in place by the OEM. The shop visits need to come down. The cost of shop visits need to come down drastically to make this thing viable in the future. The Gen X, there's just no market at the moment. I don't know what the market is. If you wanted to try and sell one outright, you'd probably take a big haircut. But the 3410E, if your engine is above $6 million book values, unfortunately, I've got one. It will not support above a $6 million book value. So the 5B current market will struggle with a book value around 7 million or more. The 7B, same. The market is not there for that. There are opportunistic people in the market looking for cheap engines so they can pack them, and later on when the market recovers, you know, they've got a cheap asset on their books. So there's a lot of options. If you have a cheap asset on your books, you can tear it down, absorb the maintenance reserves, or you can lease it out for a decent return. It's only people who are fire sailing that are in this kind of market. We have some for sale, but we don't sell at a loss. We sell at a book value profit. So there you go. There are a lot of poor engines around at the market. The A319s are spitting out 5B6s and 5B5s. Well, you know, there's no market for those things. Or low thrust 7B22s. You'll be struggling on those ones. So the sale and leaseback market today, on the Neos, the new sale and leasebacks, most of the engines have some kind of fleet hour agreement with the OEM or another alternative MRO. There are other OEMs out, like MTU has got an MRO support program for GE90s. KLM has got a Genex MRO support program. Air France is trying to do a GE90 support program. So there's a lot of non-OEMs out there. You don't have to stick with the airline doesn't have to stick with the OEM, i.e. GE or CFMI or Pratt & Whitney if they don't want to. Predominantly, we're seeing no cash maintenance reserves during the lease. Last year, this was different. We managed to negotiate cash maintenance reserves or a letter of credit covering burnt life. This year, it's back to 2019 and earlier. No cash maintenance reserves. LCs, no, none of those either. Shop visitors usually pay at the event time, so there's no risk for the airline and there's no risk for the MRO support. It's only risk on the lessor or the other owner and how this is going to work out. So that's unfortunate because, you know, we weren't too happy about that pre-COVID and now we're getting stuck with it again. So credit risk management is a real feature in the industry at the moment. So due to this kind of thing, it increases the exposure to the lessor or the investor during the lease term, and you're hopeful that there's enough money on the airline that's still operating at the end of lease. Most leases now on Neos, a minimum of 8 years, 10 and 12 is not uncommon. When I first started engine leasing, a long-term lease was 3 to 5 years. And now, you know, 3 to 5 years is, you know, especially 3 years is probably considered a green time lease. You're just burning life off the engine while you're positioning it for teardown at some point. Typically, the airline and OEM, this is my opinion, when they sign up for these kind of fleet hour agreements, they're risking someone else's money. They're not risking anything themselves. So that becomes a credit risk. So the issue with that, for me, is very unfortunate because you need to now take a different view on something. I think I might need to speed up. I think my management of this is not so flash. So poor credit lines, airlines before COVID are getting better rates today than what they were pre-COVID. There are a lot more players in the engine leasing market. Now we're seeing 16, 17, 20 plus bidders. And there's a lot of non-genuine engine leasing specialists in the market. So green time leasing, it's still there. It's gone from 4 to 18 months, possibly 16 months, burning life off the engine. No install, no payment. That's very unfortunate. I don't see how long that's going to carry on because that is not sustainable. A lot more aircraft leasing players in the market due to the aircraft being parked up at some stage and engines coming through. So engine lease values, impacts of a poor lease agreement. I'll put this in here because what we're seeing is some of the sale and leaseback market, the redelivery conditions are everything. That's where the value of your engine is at the back end of the lease, especially if you're not getting a discount on the engine value at the front end of the lease. So a lot of these new deals coming through, the engine's coming back as is, and you can easily lose up to $2 odd million on the basis of the value of your engine. Now, if that engine is placed in a securitization fund or a pension fund, then somebody who's going to buy that engine needs to be aware that there is a possibility, a very strong possibility, you're going to write a lot of money off the back end of the lease. And when you've paid $18 million for the engine in the first place, the last thing you want to do in 10 years' time is get inflation adjusted $2 million, which could quite easily be $3 million whole in your pocket at the back end of the lease. So it needs to, you know, I can't emphasize strongly enough that if you're going to be in that kind of market, as in, you know, you are providing the funding for the securitization and absorbing the value of the engine at the back end, read the conditions properly. Get an expert to give you some kind of, a specialist to give you some kind of opinion of what the cost could be. I wouldn't necessarily advise talking to the seller, who may or may not want to be quite upfront with it. But anyway, that's where it is. So that's a little picture down there. That's what your engine could look like. You know, is a car missing all its wheels? Okay. So this is just me talking about, usually if your spare engine doesn't have a QEC, it becomes the last engine off the block to get picked, because everyone wants a QEC, everyone wants a full QEC or a neutral QEC as a minimum. If you don't have a QEC, it takes about a week to cross one engine over to the other. And most airlines, just especially in today's environment, they're really time sensitive. So QECs can cost up to 20 or 30% of the initial engine purchase price. So it's a big deal. And you need to make sure that at the back end of the lease, you don't get missing parts. It's very easy to lose those kind of parts. So here's a pretty picture. This is a GE90. Produces 115,000 pounds of thrust. And if you dialed in earlier, ISTAT would have told you that's a 135-inch fan. And that's the outside of the fan, not the inside. The fan blade's 128 inches, and that will fit into a nose loader on a 747-400. And that's pretty much the only thing that'll take it. They're $40 million today, but obviously, you know, no one's going to pay that kind of thing. And there's a lot of spares available. Here's a Gen X engine, and that's in what you call a rollover stand. So you connect up the air winch and it rolls it over, and when it rolls it over, it drops it as well. So it lowers it, so it has ability to fit into a 767 freighter or a 747-400 side loader. They're over $30 million new each, but there's no demand, obviously. It's a 7B, still 15,000 of these things flying. There is a big market out there that's not going to go away in a hurry. Very reliable. I think we've been spoilt over time for the fabulous reliability built into the engine by CFM, and that reads across to the 5B as well. Currently, the market rate rents are around 45 or 50,000 a month, and that's at the upper end. There have been 25,000, 30 and 35,000 rates a few months ago. That's where it sits at the moment. If you have an engine in excess of $6.5 million, that's not sustainable. If you've got a $7 or $8 million 7B, you'll really struggle, because that's a lease rate factor of 0.5. And that's basically a no return. It's desperation stuff. There's the 5B. Similar sort of thing, new engine, 11 million, but I'm sure you can get them a heck of a lot cheaper. They're pretty much 7B and 5B, you can consider them out of production, essentially. Pretty much the same position as the 5B, except slightly cheaper, 35 to 40,000, 40 to 45,000 on if you've got a good one and you've got a 2 or 3 year lease. It's a V2500. Again, it's a fluctuating market. I'm not quite sure. It's not a stable market at the moment. It's a huge number. There are thousands of engines impacted by this AD on the turbine hubs. And we will see that come through in the shop visit support programs that will require some kind of engine support via lease. So again, just recently in the last week or two, we've been told that the lease market is firming up and the rent's sort of 55 to 60, but we haven't seen that as such. Certainly that hasn't crossed over to the purchase price, you know, or the sales price. We're still seeing that as, if you get 7 million for your engine, you've got a fantastic engine that would, in pre-COVID times, would have been 8.25. Now, you know, it's dropped quite a chunk. So here's the LEAP 1A, around 16 to 18 million plus a whole bunch of costs. The rent market for this thing is roughly 95 to 110,000 a month, roughly, depending on, there's a lot of influences of that, thrust, operations, and cost of finance. The cost of finance is just, it's moving around a little bit depending on the length of the lease. 1B, there's not a lot of 1B sale and leaseback opportunities just at the moment. So again, you know, I think if you could aim for 100, 110,000 a month, depending on the credit, that would be an obvious target. Maybe you could win the deal, maybe you might not. So anyway, that's what we're seeing there. And this is just a couple of snaps of what can happen when things go wrong. The blue one here, that's where the turbine just decided was going to go on holiday to Mallorca, and then just jumped out of the engine. Unfortunately, that is a fairly significant catastrophic event. And of course, the other one is on an A380 and an operator based in Paris that I won't say the name. And that's what happens when things let go. So quite scary moments in aviation. And this is other things that can go wrong when little bits of particles get inside your engine, and they decide the rest of the engine decides to go on holiday. So these things cost millions to fix. So it pays to have your leasing agreement secure that you don't get a phone call like we did late one night that said, come and pick up your engine. It's dropped a turbine blade. And it junked $5 million worth of value out of the back end of your engine. And by the way, we're in administration, so we're not paying for it. So these things can go wrong. That's the risk that you take in aviation. So essentially, you know, thanks for your time. I have wandered over time by 11 minutes, and I've cut you short on some of the presentations. However, you can get the presentation from me, or you can get it through the ISTAT. This presentation will be online, so you can stop it at any stage and have a look at the slides. Hopefully I've given you some kind of idea of where the COVID situation is at the moment. It's very fluid, and what was true today may not be true tomorrow. But I've tried to be as honest with you as I can. And please, any questions, please let me know.
Thank you so much, Graham. And I think we have a few questions. I'll hand over to Jen in Hong Kong.
Yeah. So the first question we have is from Doug Kelly. And Doug is asking, in forecasting engine values, do you assume a steeper depreciation of wide-body engines than narrow-body engines? And also, what about QEC? How do you forecast the value of QEC?
Hey, Doug, we haven't caught up for a while. Nice to hear. So from my perspective, unfortunately, the depreciation is it's a set legislation. So it's something that is largely out of our control. The only way that you can alter or amend the depreciation policy that whatever country that your country is registered in is via impairments or accelerated depreciation. And usually that's not on that's on a fleet-wide situation. You can't do it on a one-off, on a one engine serial number thing. So I have been involved with that kind of program earlier in my career, but the vast majority of engine lessors would depreciate around 3.5% per annum. So that's based on the purchase price. Now that can be spread across, you can have different financial rules where you can change the term of the depreciation, the length of the depreciation, as in, you know, 15 years, 20 years, 25, 30 years, something like that. It's really hard to change the depreciation. That, you know, buying a brand new engine, a 5B, 7B at the back end of the production cycle, which we unfortunately have done, you're stuck with the problem. There's no easy way out. Now, when it comes to QECs, it's not until the end of production and the teardown that the QEC values get impacted. So over time, the QECs will probably increase on a new configuration engine by around maybe 1.5% per annum over time. So it's for the LEAP and the gear turbofan and the GenX, not so much of an issue. For the 7B, the 5B, and the V2500, you can still get kits out there for 900,000, where the new list price is 1.8 to 2.2 million if you wanted to buy it from Goodrich or Collins, as they call themselves now. A used QEC for a 7B is roughly 650,000, 550, depending on the quality of the kit. So I don't see the QECs coming down anytime soon, but certainly maybe the 5B and V2500 at 900, 950 each are probably a touch high. So to get those kits overhauled by Collins, you're talking 400, 450,000, plus there may be some engine mount issue costings. The links, for example, on the 5B, there's two big links at the rear mount. They're at 35,000 each. They're not cheap. So you can get really carried away. So if your QEC's on your book for 250 to 300,000, if you add 450, you're in the 750 range. So you need to be really careful with what you do. The GenX QEC is obviously, you buy that from Boeing or part of it from GE, a big chunk from GE. If you wanted a full QEC, they're officially about 4.5 million. You can get them for maybe 3.6, 3.8 at the moment. The GE90 is really difficult. QEC, you can get sufficient kit for about 750,000 to get it to, it won't be a neutral QEC configuration. We'll get the mounts and you'll get the firewire and most of the harnesses. CF34 is really tricky. There's not that many around there. They used to be sort of 1.5 million, but I think you could probably pick them up for 700,000 if you've got a teardown engine available. So hopefully that's answered Doug's question, and hopefully Doug will catch up with a beer at some stage.
So the next question is from an anonymous audience, and he or she is asking, are there many GE90 operators on T&M contracts looking for green time leases to avoid shop visits? You mentioned the rough cost of GE90 PR shop visit. What's the rough cost percentage of a GE90 quick turn shop visit as compared to a PR shop visit?
So you need to be careful with, quick turn shop visits. They just address a one-off repair. It could be combustor or turbine blade or something like that. Once you break a flange on an engine, usually you let the genie out of the bottle, and it's very hard to stick that genie back in that little bottle because the engine shop manual will force you into certain directions. So it's really difficult. The GE90 is not EGT margin limited. It's usually it's condition limited, as in deterioration. There'll be something wrong with a part, a combustor crack or a nozzle guide vane crack, and it reaches to the point where the reliability factor is really suspect. So you need to be really careful, because both the GenX engine and the GE90 have a stage 1 turbine blade that's non-repairable, and those cost about $1.9 million a set. So there's no easy out for these things. A number of the smaller operators are on time and materials for GE. They for the OEM or some kind of contract. Having said that, I think there's a lot more flexibility around now, but I think what will happen with the GE90 is similar to what's happening with the ADC2, is that people will only pay for one shop visit. They'll only build 4,000 cycle engine. They will not build a 15,000 cycle engine anymore. The LLP stack is in excess of $10 million, which is eye-watering. Since, if, for example, the LLP stack is 15,000 cycles, and if you're operating at 6-to-1 ratios, then that's 90,000 flight hours. Most airplanes will never get there. So there's a whole bunch of LLP life that no one is ever going to get at 15,000 cycles. So people are only going to pay for 4,000 or 6,000 cycles, irrespective of how much life the LLP has. So people will be operating in that kind of environment where that $16 million shop visit is just not sustainable anymore. I would pick that there'll be a lot of DER repairs available, where you instead of scrapping a $400,000 part, you'll do a DER repair at maybe $30,000, $40,000, and that would be quite a a right thing to do. At the end of the day, you know, pricing the aeroplane out of the market because no one can afford the engine shop visit, that's not a wise move. And I would hope that the OEMs would sit down and try and rationalize that and find some kind of way to get this done. I know there are some GE programs that will give you a fixed price quote. You push your engine in and you'll get your engine out at the back end. I don't know if those are quality events or they fill them up with, you know, part repair parts. I've got no idea, but that certainly has floated out in the probably last 4 or 5 months. That you know, unfortunately, we due to the COVID non-travel thing, we're missing out on a lot of face-to-face time with the OEMs and the MROs. And these are the kind of details that you can sit down over a cup of coffee and a table with the OEM or the MRO across the other side, and you can really have a heart-to-heart talk, and you can come away with an idea of what they're trying to do and what the objective is. You know, at the end of the day, there's no common sense. If the engine is too expensive, then the MROs are toast as well. So it's no good having a bunch of toast on your plate. So look, I would suggest that the GE90 is one of these problem childs that I don't think we can fix today. Certainly, it will have a life all of its own, and it'll be separate from the Gen X. So, you know, even to the point where maybe you're looking at the 777X, which is this 777 replacement. Now, the launch customer from that is Emirates. Now, you're talking about there's really good data at the moment. That's a $60 million engine. There is no way in the wide world that anyone is going to buy a bunch of spare engines for $60 million. No way in the wide world. So something has to happen. So Boeing and GE want to get that airplane out. They need to do something about that. So I don't know how. I don't have the facts. All I'm doing is raising the issues. So hopefully I've answered the question in some form.
The next question is from Pat Caroline. Pat is asking, when do you think the market will go back to pay monthly rent from the current PBHs on narrowbody and regional jet engines?
Well, I hope tomorrow. You know, so later on this afternoon would be handy. I think, yeah, you know, I would be picking that as soon as the airlines got some kind of consistent profitability and consistent operation, where they, you know, if they're flying 70% of their fleet and you know, on a consistent basis, then they're improving that to, you know, as 100%, and they get their confidence back. I would hopefully, you know, think that the market will move. But again, it takes two to tango. You know, it's like, it's not just not the airlines. You know, it's like this whole thing is a democracy. The airlines get a vote, and so does the engine and aircraft lessors. So, you know, you don't have to accept those rates. It's only if you do have to accept those rates because you've got, you know, 30% of your engine fleet sitting on the ground with no income, and the CEO's decided that he's having a problem with that, and therefore he says to his sales and marketing guys, put everything on lease as fast as you can, and if you can and when you can, and tell me tomorrow what you've done. If you can afford to abide your time as an engine lessor and not have to dip into that kind of market, then that's something else. But I would venture to think that it's probably another 12 months away, as much as I'd like it this year. You know, we're just in the Northern Hemisphere, we're getting down to the back end of the summer season, and who knows if the COVID's going to rear its head in the wintertime, which is what everyone is, you know, fearful of. So this next summer period will be for May next year. So I would hope that the market's stabilized by then. But yeah, definitely not today, and unfortunately not this afternoon.
Our next question is from Stephen McKenzie. Stephen is asking, what's the part out values for the LLPs of a neutral QEC 7B26/3 engine values? IBA claims north of 2 million, but reality it's 1 to 1.5 million if LPT module has life?
One moment. Sorry about that. A little tricky. Essentially, if your LLP is less than 8,000 cycles, it doesn't generally have any market value. So I know that is hard, but if you're going to do a performance restoration on a core of a 7B or 5B, they're the same. They are interchangeable parts, although the inspection criteria is different between the 5B and the 7B. If you're going to spend around $2.8 to $3.3 million on a performance restoration and you only build it for 8,000 cycles, you have just wasted your money. Because you now have to charge twice the cost per flight hour as if something you built it for 20,000 cycles. So the sweet spot is 10,000 cycles in the market, and there are very few of those LLP stacks out there. So, you know, there's a bunch of 5,000 cycle core, 6,000, 7,000 cycle core, but usually speaking, around 8,000 cycles or less, very difficult, and you will probably get dollar for dollar. So we value ours slightly differently. You need to take, if your LLP, then you're probably only going to get about 75% the value, the stack value. The LPT aside, so the QEC as removed is probably about 150 to 250,000 max, unless you've got very recent evidence that it's been overhauled on the engine mounts, for example. Engine mounts can be $100,000 each. 7B QEC is totally different from a 5B and V2500. So 7B is very comprehensive. The 5B and 7B is very skinny. The 5B and 7B, you, apart from the engine mounts, you just get a large number of brackets and cables and harnesses. On the 7B, you get things like the anti-ice valve and all the tubes and harnesses and the valves. The only thing you don't get is the exhaust system, the PRSOV, which is a pressure relief shut-off valve, the check valve, and the nose cowl. On the V2500, it's pretty skinny, it's pretty light. You still have to buy the starter motor and the start valve and some of the ducting, some of the extra valves as well, hydraulic pump, IDG, all that kind of stuff. So yeah, so the 10,000 cycle CFM, it's a pipe dream. Everyone wants those. And you'd probably pay 100% value on that. So if you're buying, if you're selling, maybe 85%, because you still have to overhaul it, present it. You can't ask more than list price. At some stage or another, probably another 3 or 4, 5 years for the 7B and the 5B, no one will pay 20,000 cycles for an LLP. They'll be down into the 15,000 cycles or something like that, because no one will build a 10-year engine or 12-year engine. They'll only build a 5-year engine. So they will absorb all of that goodness. They will accept it and they'll buy it, but they'll charge for it, you know, as in the LLP rates going out to the aircraft guys, you know, they'll charge them the full LLP rate, but they won't pay for it initially. You know, I think historically, if you wanted to see where this 5B and 7B will go, is look at the 3C1, 3B1, 3B2, and 3C1 series off the 737 Classic. That's exactly where they went, and so will the 7B and 5B follow those.
Our next question is from Alistair Forbes. Alistair is asking, can you add any color about PW 1100GJM values? Is there still an oversupply from the earlier GTF issues?
Is there any Pratt & Whitney IAE reps online at the moment? Am I going to crucify myself? Okay, so this is, I'll give you my opinion, and please, IAE, I'm friends with you guys, honest, you know, please send me Christmas cards. But what I'm going to say may not be comfortable for some people to hear. Okay, so in my opinion, the PW1100 was rushed to service. they set the design too early, and that was based on $150 oil barrel prices. You know, they rushed it to service, trying to get an accelerated gain over the competitor. They locked the design in, and when you lock the design in, you're stuck with it. And you can only change that design once it goes into service and you see whether you're right or wrong. Now, it was very swiftly apparent that when the engine entered service and was rejected by the entry to service operator in Qatar, and therefore picked up by Lufthansa Technik, or Lufthansa Airlines, I should say, that they hadn't done their homework right. They're on their fourth combustor now. There's a whole myriad of problems that just won't go away. You know, fix this, fix that. It's like trying to squeeze a balloon. You know, if you squeeze a balloon, the air pops out somewhere else. You know, and you're continually trying to squeeze this bloody balloon into a smaller shape. So it'd be my opinion that, you know, they rushed it to service. The price of oil fell and didn't support the premise that the engine was initially promised under. On top of that, I believe Pratt & Whitney had made a conscious decision to dominate the spare engine lease market and dominate the total spare engine supply and demand. And they made hundreds of these things. The spares ratio at one stage was about 70% on an engine that was designed to have a spares ratio of maybe 8 or 9%. In reality, that's where it should be, 8 or 9%. Now, they may get there over time, but the spares ratio today is still 27%, which is way over the top. And not only that, but IAE is disposing of those spares into the market as well. And then when you look at when they have the XW, the extra long range A321, there's going to be a new configuration pre-W1100, and they may not have a full intermix ability. So you'll be backwards compatible, but not forwards compatible. So if you've got the old configuration, it may not fit on the new wing. So then you've got a problem of you know, self-imposed reliability and interfect issues. So will the fixes come through on PW1100? Yes, they will. It's just going to take time. But at the moment, there are sensitivities in the engine, and you know, some of the issues will take a long time to fix. The Pratt & Whitney, you know, these guys are not fools. They've invested billions of dollars in this. It's catch-up stuff that maybe would have been better if they'd have delayed the engine design release to service. Maybe if they'd have delayed it 12 months. It would have been really helpful if they'd have actually put the engine into the environment they were going to fly into and sell into initially, and done some significant testing for 6 months. Given that the V2500 struggled in the hot and harsh environment, they were going to put their V2500 replacement, the Pratt & Whitney 1100, into the same environment. It probably would have been a wise idea if they'd actually gone down there and spent some significant time down there running it. So, as I say, they're on their fourth combustor now. You know, they've replaced the LPT blades. They were titanium blades, and now they're pneumonic alloy or steel blades. That's changed the weight. They put, it just, again, this is my opinion, and I'm quite happy to have a detailed discussion with anybody on it, but I believe the engine is missing a 4th stage LPT, and they've done that. It's only a 3-stage LPT because of weight. And they needed to make the weight limit that Airbus set them, which the LEAP engine made, and the geared turbofan didn't, because it's got this gearbox. It's got this bearing gearbox in the front. Now it's missing a 4th stage. Now you're trying to extract 35,000 pounds worth of thrust out of a 23,000 pounds thrust core spinning at 22,500 RPM on takeoff on a 3-stage LPT. That's difficult. I mean, that's really difficult. You can see the same heat platform coming out of the LEAP, and they've got 6 stages. So maybe that's a stage too many, but that's a design issue as well. So, so there are issues in the design philosophy, and I'm quite sure I'm going to get a lot of emails from Pratt & Whitney very shortly, expressing their disappointment with my opinion. But I'm quite happy to sit there and say, I've done 43 years in the industry. I've done 15 years in the engine shop. I'm an engine specialist. I'm a licensed engineer. I'm a certifying engineer. I know my way around the engines, and these were just my opinions. I'm more than happy to be proven wrong, and in which case I will admit. But that's what I see the Pratt & Whitney 1100. So I'm not sure if I answered the original question.
Great. Maybe you want to just do a summary of the ensuing discussion with various people who send you emails, and then add that as a final slide on the presentation that will be posted on the ISTAT portal, because it could be interesting to see, other views on this same issue, I think. Thank you so much, Jen, for running the questions. Thank you so much, Graham, for this very interesting presentation. And we are going to see you back on August 31st, Tuesday, August 31st, for a learning lab on the ISTAT Foundation's scholarship program. Thank you so much. Have a nice evening or afternoon, whatever it is.
Thanks everybody for dialing in, and thanks for the ability to share some thoughts in the market.
Thank you.